Hey, Steve Saretsky here. As always, a Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, I'll ask that you hit thumbs up and subscribe. Questions, comments, put those below. This video this week is going to be a little bit more complicated. I'm going to dive into a little bit on the banking system side of things, credit spreads, etc. Things that all matter, and there's a lot going on behind the scenes, particularly from the Bank of Canada, that I think is very important to be watching moving forward. So I'll try to explain that in as simple as possible terms. First and foremost, looking at what's happening in the Canadian credit space, the Canadian yield space, bond market, etc. The Canada 5-year bond and the Canada 2-year bond, most recently, those yields inverted. And so what that means is essentially the bond market is telling you that they are anticipating future growth to be weaker in the economy. It also likely forecasts that the central banks aren't going to get as far as they wish in their hiking plans. And it's basically sort of like a leading indicator that they feel a recession is oncoming in the near term. And so again, that's not to say it's bulletproof science is going to happen, but this is generally the bond market signaling that economic prospects aren't as great as perhaps the central bank or your bank economist wants you to believe. And so what this happens is you have to look at real estate or bonds as any other investment class. They all work the same. As Howard Mark explains it, there's sort of this risk premium that the longer that you go out in duration, meaning that if you're investing, let's say you want to buy a Canada 5-year bond, well, you would think that you should be getting a better rate of return to tie up your money for 5 years versus than tying your money up for, say, buying a 2-year bond. But what's happened is right now the return is essentially the same. So you can either tie up your money for 2 years and get this return, or you can get tied up for 5 years. So generally there's like a risk premium. So your typical yield curve it's upward sloping versus where now we have is this flattening yield curve. And this also can impact banks' profitability from a lending standpoint. Again, think about a bank, they're lending a 5-year mortgage, at the same rate when they should be technically, they could technically lend it out at a 2-year rate as a hypothetical, and they should be getting the same return. So it's making bank profitability, less so. And so, it's funny because I talked to some mortgage brokers. They say, well, look at the Canada 5-year bond, it's declining. You would think that 5-year fixed rates on mortgages should be coming down. But as I said to them, I'd be cautious about jumping to that assumption when you have a yield curve that is flat and inverting, and you also have, at the end of a credit cycle and have a housing boom, when the banks, I think they're pricing in a risk premium. In other words, that they feel there's more risk out there, so they're basically going to keep that increased spread in there. So, moving forward, you can see this starting to reflect in the detached housing market. I know the banks are getting a little bit tighter in that aspect, obviously, along with the B20 stress tests, and you can see that reflecting in the Vancouver detached home prices, which, year over year have declined 8.5%. To the largest decline since we've experienced year over year since 2009. So that'll be something to keep an eye on. Coincidentally, talking about these real estate prices declines and really seeing really weak housing markets all throughout the nation. Even if Toronto, you want to call it a recovery, you'll still see annual sales this year coming in at its second weakest year since 2008. So it's really a weak national housing market, and that has really prompted the Bank of Canada into action, and that's something that I want to discuss in this video primarily, is that generally what happens is for banks to, when banks issue a loan, they generally don't keep, a lot of the times, they don't really keep that loan on their books. What they basically do is they pool them into a mortgage-backed security pool. They take all these mortgages, they pool them in, and they sell them off to investors. And so these are generally called, they'll pool them into like either a mortgage-backed security pool, or they'll basically funnel it into a Canada mortgage bond. And then, and pension funds, etc., buy this debt because this debt is ultimately secured by CMHC. CMHC guarantees the payments. In other words, if some of these mortgages should go bad and the borrowers don't pay their mortgage payments, etc., CMHC basically steps in and says, no, don't worry, we're going to guarantee that you get paid regardless of what happens. And that ultimately comes back onto the taxpayer. So CMHC knows that they've created this, way too much exposure to the taxpayer, and that's why they've really been reining in their insurance portfolio over the last 4 or 5 years. But despite that, as of 2015, I believe 58% of mortgages were insured by the Canadian government, and in particular CMHC. So anyways, long story short is when they take these mortgages, they sell them in a lot of times Canada mortgage bonds. And this basically helps bank funding. It helps them, clear off their balance sheet so they can basically issue new loans. And so generally, the Bank of Canada came out at the end of November and said, first off, let me explain this. The Bank of Canada, they generally, regularly purchase assets to offset their liabilities. So they're like any sort of bank, they have assets and liabilities. So what they'll generally do is they'll buy Canada government bonds, not like en masse, not like quantitative easing, but they're just doing it to offset their liabilities. And so what they came out at the end of November and said, we're going to start purchasing Canada mortgage bonds, but only if the investor appetite is not there to meet it. And historically and year to date, that has not been an issue. So we will only be stepping in if investors don't meet the requirement in order to sell the amount of Canada mortgage bonds that we want to sell. Well, sure enough, 3 weeks later, earlier this week, the Bank of Canada quietly went behind the scenes and purchased $250 million worth of Canada housing bonds. And so what this basically tells you is that, well, first of all, there likely wasn't enough of an appetite from the investor market to fulfill this. So that already raises you questions. Second is the optics behind it. Why would the Bank of Canada, after all this time, after 10 years into an economic expansion, all of a sudden decide that now is the right time to change up our allocations and start purchasing Canada mortgage bonds? So you can think of all these sort of conspiracies, and I'm not going to jump to any conclusions, but obviously the timing of it is very ironic. And I actually spoke with someone that used to work at CMHC, and he said, yeah, it's just bad optics. He's like, we wouldn't have never done this. Like, it's just really bad optics. And so, a lot of the times the market will perceive it as, well, hey, look, the Canadian housing market's clearly, weakening at the end of a credit cycle, and now the Bank of Canada is buying Canada mortgage bonds. Bit of a red flag, but if you actually look into the deal, they initially offered them at a 30-point spread, and then they had to offload them they didn't sell them all, so they had to offload them at a 40-point spread. And that really goes with the Canadian credit spread. Basically, investors are asking for a higher rate of return, and you can see the credit spreads are starting to widen in the Canadian credit space, and that's going to be, again, very important for when you're trying to sell Canadian mortgage-backed securities or Canada mortgage bonds. So anyways, long story short, what does this mean for the market? Just dumb it down for me. Basically, what it means is nothing in particular at the moment. It means that it looks like investor appetite is starting to dwindle a little bit for Canada mortgage bonds, maybe mortgage-backed securities. So they could start asking for a higher rate of return that could then in turn start to influence borrowing costs, despite maybe what your 5-year bond is doing. So this will be important to watch. I think what it does is it ultimately the Bank of Canada, I think, is laying the foundation. They're laying the plumbing work, saying that they're coming out and they're going to buy Canada mortgage bonds if need be. In my opinion, that lays the framework where if we get into a substantial housing decline, that these guys are going to be ready to step in, and I've said this before. I think it's almost a guarantee because you have interest rates at 1.75%. I don't even think they're going to get to 2%. If they do, they'll be lucky. So let's just say they get to 2%. Really doesn't give you much room to cut rates to re-stimulate the economy. It runs a situation where yields could really start to blow out. In terms of borrowing costs, bank funding, etc. So this is really a move for the Bank of Canada to say, okay, well, we need a little bit more tools in the belt, so to speak. So if need be, we'll start buying up Canadian mortgage debt to basically help stabilize borrowing costs, to help stabilize the housing market if need be. Now, this isn't like a guarantee that like a housing correction can't happen, because you look at the States, the U.S. Federal Reserve bought a whole, I think, trillions of dollars worth of, mortgage-backed securities, and home prices still dropped, 40-50%. But what it does is, and I would argue they probably would have kept falling if they didn't introduce all that asset purchasing by the Fed, through mortgage-backed securities, through the TARP program. So that's pretty much it. I've probably rambled on too much on that topic, but I think it's extremely important to development to understand the mindset of Canadian regulators, to see where they're coming, because they say one thing sort of in the media, and then they do other things quietly behind the scenes that pose questions. So you have obviously CMHC reining in their insurance portfolio, to really trying to cut back on taxpayer exposure to the Canadian housing market. And then you have OSFI coming in behind the scenes, bringing in mortgage stress tests, quietly going into CIBC, TD, and these guys, and making sure that they're doing more prudent lending, and they're really dropping the hammer on these guys. And then you have the Bank of Canada quietly behind the scenes, all of a sudden starting to purchase Canada mortgage bonds. To me, that really tells you that these regulators are really watching this with, I think, some concern. I mean, they wouldn't be doing these policies if they didn't feel that there was a vulnerability in place. So that's something that I'm obviously watching. I mean, truthfully, people are going to have mixed reactions on this, but I think that, it's ultimately, I'm not a huge fan of quantitative easing if that's the direction they go, but you can't have a huge housing collapse for the economy. It's not good, especially when your interest rates are where they're at. So I think they're really just laying the framework and the plumbing just in case. Like I said, nothing is a foregone conclusion. Anyone that tells you prices are guaranteed to drop or crash or collapse, doesn't know, I think, the capability of central banks, etc. Quick little tidbit. Some people have asked me about, this whole Huawei case, Huawei, Meng, and how this might impact the Vancouver housing market. Are there going to be people, rushing to sell, etc.? I don't think so. I haven't heard of any stories. Obviously, it's too soon. If you're saying it's going to have an impact, you're just guessing. There's no data to suggest that. I haven't seen an increase in new listings, etc. Obviously, it's December. But I would say, obviously, a lot of the foreign investment has clearly dissipated over the last while, and we can see that clearly in the luxury housing market here in Vancouver. But I think another thing I'd be looking at, not so much from a political side of things, obviously that is important with the trade wars, but I would look at the China's M1 money supply growth, which is really rapidly decelerated. And if you look at the chart, you can see in 08-09 is their M1 money growth year over year just exploded higher, and that was really a result of the financial crisis. China was basically the stimulus to support the global economy in the recovery. They basically went into this crazy credit creation, money printing, if you want to call it, frenzy to keep things afloat, and they really led global growth through that. And now you can see that with China slowing down, trying to stabilize their economy, their money growth is really starting to decelerate, and that really matters in credit markets and in global liquidity. So that's something that I would be watching moving forward. I would also be watching with a close eye the Bank of Canada and what they do. So anyways, hope that helped. Otherwise, see you next week.